Okay, welcome to the class session today. So this is simply the same session that we did in Sinhalese. We will be conducting the same session in English medium as well for us to make sure that you pass the AAT exams successfully. So this is again, if I'm to remind you, this is the subject is management, accounting, and finance, which is under the third stage of AAT. So huge thanks goes to the AAT Institute for organizing the webinar series for the students to get the maximum benefit out of it. All right. So with that, we will be starting the session for today. So today I will be conducting the same session that I did in Sinhalese in English medium as well. So to begin with, let me share the screen. All right. So I hope my screen is visible to you all. So let me put this on the presentation mode. Right. So as you all can see, if I'm to give you a brief introduction about myself, I'm Anjana Sri Chandrakanthan, and also I'm a CIMA pass finalist, and also I am a AAT member. So I have been conducting classes for AAT, CMA, and also ACCA. So to begin with, you can see this is management, accounting, and finance. This is the subject that area that we are focusing on. And specifically, we are focusing on the advanced variance analysis. Okay, students. So what the reason why we have selected this subject area to talk about or to do a separate webinar on it is because most of the students, based on the analysis of this answering pattern of the students, we have observed that most of the students have scored lesser marks when it comes to advanced variance analysis. So students, one of the main reasons why we see that the students have messed up this question is because they don't remember the formulas, or they have messed up the formula. They have created new formulas. Okay, so that should not happen, students. So I'm going to teach you how to easily remember these formulas, and also to make sure that you score well in this subject area. Okay, students. So moving forward, advanced variance analysis. So students, this is not something new, students. This you already know. So because the thing is, this advanced variance analysis is just an additional point that is getting added up to the previous knowledge that you have already gained. Okay, so you have already gained previous knowledge on this advanced variance analysis, but this subject at this stage of AAT, you're going to learn about the advanced variance analysis, okay, where we talk about some new stuff that is getting added up to your existing knowledge. Okay, so I'm repeating again, this is nothing new to your students. This you already know. I'm going to add up some new knowledge onto the existing knowledge of yours in the third stage of AAT. All right, students. So if I'm to say, this is now when it comes to students variance analysis, it's not just only about the cost variances we are going to talk about. We are also going to talk about the revenue variances as well, Amai. So the thing is, this revenue variances, or we call them as sales variances, we have a separate set of variances for that. So that, of course, you have not come across yet. When it comes to cost variances, this, of course, you have come across already, right? So when it comes to this cost variances, you can see if I'm to show a summary of the cost variances. So this is the summary, Lamai. This is what we are going to talk today. Okay. Regarding cost variances, you can see production cost variance we categorize into 4. We are going to talk about the total material cost variance. We are going to talk about the total labor cost variance, variable cost variance, and the fixed overhead cost variance. Variable cost variance as in variable overhead cost variance. Okay. So when it comes to material cost variance, we are going to talk about, we already have discussed, this is old knowledge, okay? So we have discussed about, now there are possible, now when it comes to material cost, it could change only because of two possible reasons, okay? Either because the price has changed, price of the material has changed, or the cost would change because the usage has changed. So it's either of these two reasons that could have led you to a change in the cost. Okay. How do we calculate the total cost? It is price multiplied by quantity. So when we take this, either it could be because of a change in the price, or it could be because of a change in the quantity or the usage. Okay. So same thing here. So we are going to talk about material price variance, material usage variance. Under usage variance, today we are going to learn about two advanced aspects, that is direct material mix variance and the yield variance. Okay. And then we have the other one, total labor cost variance, under which we are going to talk about three. You all can see we have the direct labor rate variance, idle time variance, direct labor efficiency variance, and we talk about the direct labor mix variance. Under efficiency variance, we talk about mix variance and the yield variance. Variable overhead cost variance, we talk about variable overhead expenditure variance and the variable overhead efficiency variance. Okay. And then we have the fixed production overhead variance, under which we talk about the fixed expenditure variance and the fixed overhead volume variance, under which we talk about the capacity and efficiency variance. Okay, good. Now let's move on to, so what we will be doing, Lamai, we will be taking one by one, each item separately and talking about the formulas. Okay. See, Lamai. So the first thing we are going to talk about is the direct material variance. Direct material variance, you can see it divides into two, price and usage further divided into mix and yield. Okay, so we'll take one by one. This is previous knowledge, Lamai. Okay, so direct material cost variance is simply the difference between the standard direct material cost and the actual direct material cost. ඒකනේ අපි බලන්නේ. In the direct material cost variance, we take the standard cost and the actual, compare and get the variance. So this cost, further we'll break it out into two based on the price variance and the usage variance. So Lamai, when we are considering the price variance, so price variance කියන්නේ prices දෙක අතර තියෙන වෙනස. ඒක ගන්නකොට we multiply by the quantity. Okay, so අපි ගන්නකොට ළමයි මතක තියාගන්න, so when we are comparing two prices, so standard price, actual price, ඒ දෙක අතර තියෙන difference එක multiplied by the quantity, then only you get the total cost, quantity into price. Okay, so whenever, remember ළමයි, whenever you're multiplying, so this is how it happens. Okay, so when you're taking a variance, factors, now normally cost එක වෙනස් වෙන්න factors දෙකක් තියෙනවා ළමයි. Either it will be the price or it will be the quantity. If it is the price, then if you're focusing on the variance of the price, you have to hold the other factor constant. If you're taking the variance of the usage, then you have to hold the other factor, which is price constant. So Lamai, if you're holding quantity constant, and initially when you're taking the variance in the price, api constant tiyanne quantity. If you're holding the quantity constant, you're normally ganne the actual material quantity. Api direct material usage variance. Ekedi balanne usage ke quantity eke venasa. So you're analyzing the standard quantity and the actual quantity, and then you're holding price constant. So when you're holding price constant, Lamai, always it will be the standard price. Standard price. Okay. Good. Then the next thing that we have is the advanced variances. මේ දෙක තමයි අපි අලුතෙන් ඉගෙන ගන්නේ මේ stage එකේදී, that is the direct material mix variance and the direct material yield variance. Direct material mix variance එකේ මොකක්ද කියන්නේ ළමයි? It simply says, okay, our standard price අපි බලන්නේ, so what is now remember ළමයි, direct material mix and yield variance එන්නේ මොකක් යටතේද? Under usage variance. So under usage variance නම් either same thing, okay, then usage variance එකේ we hold price constant. එහෙනම් මේ formula දෙකේ we hold price constant. So we take the standard price. අර bracket එක ඇතුලේ තියෙන එක තමයි වෙනස් වෙන්නේ. See. දැන් මොකද්ද මේ direct material mix එකක් කියන්නේ ළමයි? Now when we are producing something, අපි material ಜಾති එකක් නෙමෙයිනේ දාන්නේ. There will be several types of material that we input into the production. එතකොට මේ material දානකොට ළමයි they use a proportion. For example, if we take this concrete production. Concrete හදනකොට ළමයි cement obviously. Cement හදනකොට ගල් දානවා, වැලි දානවා, ඒ වගේ ගොඩක් දේවල් දානවා. එතකොට ඒගොල්ලෝ කිව්වොත් හරි අපි plan කරන්නේ ගල් ගෝනි දෙකකට they are going to put 2 sacks of rocks and 1 sack of sand. Okay? So that is the proportion. That is your mix. Okay? So let's see. We will do a sum and then you will understand how this mix is going to change. Okay? So what do? We take the total actual material. Then metana mix variance එකේ බලන්න, if you change the mix, what is the impact? Okay? So එහෙනම් මොකද්ද වෙනස් වෙන්නේ? The mix only. So you have to take the actual material usage multiplied by the standard mix and the actual material usage multiplied by actual mix. Okay? හරි. මොකද්ද මේ අනිත් එක? Direct material yield variance. Direct material yield variance එකේ මොකද්ද කියන්නේ? We have the standard price and then බලන්න yield එකේදී බලන්නේ ළමයි අපේ usage එක, අපේ material usage එක standard mix එකටම ගන්නෙ. So C ළමයි මෙතන බලන්න formula එක අපි yield එකෙන් yield කියන්නේ මොකද්ද ළමයි? අපේ output එක. Final output එක. So මේ mix එක use කරලා standard mix එක use කරලා අපේ output එක කොහොමද වෙනස් වෙන්නේ? Let's see. See the formula. Total standard material usage. Total standard material usage on actual production. Okay. Multiplied by standard mix minus actual material usage multiplied by standard mix. දැන් අපි බලන්නේ උඩ variable එක වෙනස් වුණොත් කොහොමද impact එක. Okay. See standard minus actual. උඩ එකේ actual minus actual but mix එක වෙනස් වෙනවා. මෙතන standard mix එකමයි but උඩ factor එක වෙනස් වෙනවා. That is the difference. Okay. Right. Now we'll do this question ළමයි. Harida. So this question is extracted from your study text itself. So you can see, given below is the standard material cost for product Y produced by specific limited. So they have given you the direct material A and B. Material dekak use karanawa and they say 6 kilograms at a price of 15 per kilogram. So to produce 1 unit of Y product, you need 6 kilograms of A and 4 kilograms of B. Okay. And the information for the last month is given below. Okay. They have given below the last month information usage. Okay. Material A can total consumption 16,000 Ghana and rupees 16 at rupees 16 per kilogram on Nomadilati. Actual production of Y for the month, current month is 3,000 units. Calculate the variance. Sorry, last month actual production is 3,000. Now calculate the material cost variance, price variance, usage variance, and the mix variance and yield. Then balan mulimma anit multika you all know. So A, B, C you all can calculate. You know that. Okay, let's see the answer. Direct material price variance එක බලන්න actual material quantity multiplied by standard price minus actual price. මොකක්ද standard material? Now you have to take separately. හරිද? material දෙකක් තියෙනකොට you have to take separately. Material A actual quantity කීයද? 16,800 and 13,000. ඒක ගත්තා. Price fluctuation, standard price for material A is 15, actual is 16. Then for B, it's 10 and 9. Actual and the standard. Multiply kara. variance එක ගත්තා. So what is this FA එහෙම කියලා alphabet එකම දාලා තියෙන්නේ. It is A කියන්නේ adverse. It's a adverse variance which is not a favorable variance. F කියන්නේ a favorable variance. ඒ කියන්නේ හොඳ variance එකක්. ඒක improve වෙලා. For example දැන් ළමයි බලන්න අපි මෙතනදී බලන්නේ price එකේ වෙනසනේ. A වල අපි expect කරා රුපියල් 15ක් වියදම් කරන්න. But we have spent 16. It's not good. It's a cost. B වල අපි expect කරා රුපියල් 10ක් spend කරන්න. But actually we have spent only rupees 9. Okay? So which is good. Okay? So it's a favorable variance. It has a මේ දෙකේ summation එක අරන් overall there's an adverse variance of this. ඊළඟට so other stuff you know how to calculate, you know, material price variance, quantity variance or cost variance, you know. දැන් අපි යමු අද අපේ පාඩමට. That is material mix variance. කොහොමද mix එක ගන්න? Standard price you know material දෙකටම 15 10 කියලා දෙකක් තියෙනවා. Actual material usage multiplied by standard mix. Actual material usage එක මොකක්ද ළමයි? දැන් මේගොල්ලෝ කියලා තිනවා total you have to take ළමයි. Remember, you have to take the total actual material usage which is the addition of these two. හරිද? Total usage multiplied by total, okay? Total actual usage multiplied by the standard mix. So standard mix එක කීයද? It is 6/10. How do we get that? දැන් බලන්න මෙතන standard mix එක ළමයි. So sorry. We are supposed to take the standard mix no. බලන්න standard mix එක කියන්නේ මේක. එක product එකක් හදාන එක unit of to produce 1 unit of Y you need material A 6ක් B 4ක්. So that is your mix 6:4. So then total ගත්තම ළමයි total material consumption ගත්තම අපිට 10ක් ඕනේ 6 plus 4. ඒ 6 plus 4 10 වලින් 6 ඇවිල්ලා A වලින් 4 ඇවිල්ලා B වලින්. එහෙනම් you can see 6 out of 10 minus it has a total production. Then I think total material usage actual multiplied by actual mix. කොහොමද actual mix ගන්නෙ දැන්? Actual mix of product A. Actual mix එක තමයි මේ දීලා තියෙන්නේ. 16,000 13,000. So මේකේ proportion එක ගන්නෙ කොහොමද? You take the total of these two and then take this one as the proportion of A. That is your material A mix එක. See? That is how we have taken. Then you multiply and then you get the answer favorable. And then for B, B also same way. Standard price එක රුපියල් 10යි. Actual material usage එක remember total actual material usage ගත්තා multiplied by the standard mix which is 4/10. Okay? Here 13/29,800. ගත්තා. හරිද ළමයි? ඒ විදිහට you have to consider. So overall summation of these two would give you the material mix variance. පැහැදිලිද ළමයි? That is how we take the mix. Then we have direct material yield variance. Direct material yield variance එක කොහොමද ගන්නේ ළමයි? You have the standard price, total standard material usage multiplied by the standard mix. කොහොමද ගන්නේ දැන්? A වලට standard price is 15 you know. Total standard material usage කොහොමද ඒක ගන්නේ? Total standard material usage එක ළමයි remember it's on actual production. මෙතන තියෙනවා 6ක් මෙතන තියෙනවා 4ක් total 10 kilograms per unit. And how many units have they produced? Actual 3,000. So you have to multiply by 3,000. So total you have to take 3,000 into 10 kilograms. 330,000. Right? ඊට පස්සේ proportion එක ගන්න. Standard mix එක you know no, it's 6/10. It has an actual material usage ඇවිල්ලා අර summation that is 16,800 plus 13,000 අපි add කරලා ගත්ත value එක 29,800 again multiplied by the standard mix. Then you get the variance. Same way for material B, total standard material usage on actual production. Remember ළමයි හරිද standard into standard ගන්නෙ නැහැ. හරිද? ඒක අරගෙන 4/10 gatta. That is your standard mix. Then you get the answer. Okay, lamai? Right. ඔය ටික තමා material variance එකේ advanced variances. Okay? So the next one what we are going to talk about is the direct labor cost variance. Direct labor cost variance එකේ ළමයි we have 3. Okay? Direct labor rate variance, and then we have the idle time variance and the direct labor efficiency variance. හරිද? Direct labor efficiency variance එක ගත්තම we have direct labor mix variance and the direct labor yield variance. මොකද්ද මේ variances කියලා අපි බලමු. See, direct labor cost variance එක ගන්නෙ කොහොමද ළමයි? Standard direct labor cost minus actual direct labor cost. Direct labor rate variance එක ගන්නෙ කොහොමද ළමයි? It's the actual labor hours multiplied by බලන්න labor rate variance එක ගන්නකොට අපි rate එකේ වෙනස බලන්නේ holding the hours actual hours constant. එහෙනම් quantity constant වෙනකොට ගන්නෙ මොකද්ද? Actual. හරිද? Standard rate minus actual rate. Labor efficiency එකේ බලන්නේ quantity එකේ වෙනස hours ගානේ වෙනස. එහෙනම් rate එක constant කොට we take the standard rate. එහෙනම් standard hours minus actual hours you get the multiplied by the standard rate. Idle time variance. මොකද මේ idle time variance කියන්නේ? That is idle time කියන්නේ ළමයි දැන් හිතන්න ඔයගොල්ලෝ business එකක් කරගෙන යනවා. ඔය business එකේ machine එකක් කැඩෙනවා. ඒක කාගේ වැරද්දද? Employees ලගේ වැරද්දද? නෑ. Okay, it's the fault of the company. ඒ company එකේ හරියට මේ machine එක maintain කරපු නැති නිසා the machine has broken down. So what happens when the machine is broken down? They need to repair it. To repair the machine, it takes some time. When it takes some time, lamai, the workers will be idling. What do you mean idling? They don't have work. They don't have work to do, but they will be paid for the hours that he spent at work. So actually it is a loss. So we have to take the idle time variance. So you take the idle hours, the amount of time that the employees have spent idling, multiplied by the standard rate. So that is an inefficiency of the company. Right? Then this is the lesson for today. That is direct labor mix variance and the yield variance. Then lamai, just like how we did for direct material, we do have variances when it comes different types of labor. Just like how we had different types of material, we have different types of labor that we use as well. There are skilled labor, semi-skilled labor, unskilled labor. There is contract basis ones, part-time and full-time workers. Likewise, we have different types of workers. So that workers also, we use it at a mix. Okay, if we are using 2 skilled workers and 1 semi-skilled worker, that is a mix. Okay, same thing. So standard rate multiplied by actual labor hours on actual production multiplied by standard mix, and the actual labor hours on actual production multiplied by actual mix. Then yield variance means when you take the standard mix, how will be the usage? Okay, how will the usage change? So that variance we have taken again. Remember, lamai, here we take the total standard labor hours on actual production, actual usage. Okay, and the actual labor hours on actual production. Let's see this question now. See, given below, again, this question is extracted from your study text. So see here. Given below is the standard direct labor cost of product Z of CJ company. They have 2 types of labor, skilled labor and unskilled labor, and they require 6 hours of skilled labor and 4 hours of unskilled labor. That is the standard. Then we have the actual information. Production is 100, and they have semi-skilled and the skilled labor proportion as well. Direct labor cost, rate, efficiency, labor mix, and yield. So these the first 3 you all know how to calculate. So we'll get on to business. That is, we are talking about the new stuff. So see, if you take the rate variance, if I just explain, If you take the direct labor rate variance, you take the actual hours multiplied by the rate. Okay, so actual hours, how much? 500 and 550, not the total. You have to take it separately and the rate change. We have budgeted for 60, we have spent 65. We have budgeted for 50, we have spent 45. So one is favorable, other one is adverse. Then take the summation, the net impact. Then we have the direct labor mix variance. So how do we take the direct labor mix variance? You can see standard rate multiplied by total actual labor hours multiplied by standard mix, and the total actual labor hours multiplied by actual mix. You change the mix. How do you get the standard mix? See, 6 hours and 4 hours, total hours 10 hours. Out of 10 hours, 6 hours will be skilled labor. That is your proportion, 6/10. How do you get the actual labor hours? 500 plus 550 together, 1050. And then again 1050 multiplied by 500 out of 1050. That is your actual mix. Favorable. Semi-skilled, unskilled also same way. It is 4/10 and then it is 550 out of 1050. Get the net impact. Then we have the direct labor yield variance. So under this, we are talking about the change in the usage. See, first one, standard rate. How did we get 1000 here? It is the standard labor hours into actual production. See, the standard labor hour requirement is total 6 plus 4, 10. How many units? 100 units. 10 into 100, 1000. Okay. Multiplied by 6/10, 1050 is the actual multiplied by 6/10. Same way for unskilled labor as well. Then you get the net impact. Right? Hope it's clear. All right. So now let's get on to the other part of the session. Yes. So after considering this, now we are moving on to variable overheads. Okay. Now variable overhead cost. Here you can see we are talking about the expenditure and the efficiency variance. Okay. See, this is the formula. We have the variable overhead expenditure variance, which we take it by taking actual. So remember why, students, why do we take labor hours? Because we take the labor hours because labor hours will show you the variable overhead composition. So this is under absorption costing. So we assume labor overheads are allocated based on the labor hours. So we take the labor hours and the standard rate, actual rate, what are they? It is not the labor rate, it is the variable overhead absorption rate. Okay. So that is how we take. These are the formulas. Okay. Now let's see. Fixed variable over now see this one. Okay, variable overhead expenditure variance means you take the rate, change in the rate, holding actual hours constant. Then variable overhead expenditure variance, you take the change in the hours, holding the price constant. So price or the rate will be the standard rate, remember. Then we have the fixed overhead cost variances. Fixed overhead cost variances, we have expenditure variance and the volume variance. Under volume, you have capacity and efficiency. Okay. So for y'all, we have mentioned about the fixed overhead expenditure variance, which is simply the budgeted fixed overheads minus the actual fixed overheads. Very easy. And when it comes to fixed overhead volume variance, we have the standard rate. Volume variance means change in the hours. No? So we hold the rate, fixed overhead rate constant, and we change the hours. Okay. Right. So are you all clear with these expenditure variances? So if I take you back to our summary, you can see. Okay. So there is a method of checking the accuracy of your answer, Lamai. Okay, so if you see, you will be asked to calculate so many variances. No? So to see whether your answer is correct, you can use this flow chart, Lamai. So using this flow chart, you can find out whether your answer is correct. So which means if you add up the mix variance and the yield variance together, it should add up to the material usage variance. And then material usage variance plus the price variance should be equal to your material cost variance. Okay, so same way you can use this flow chart and find out whether your answer is correct or wrong. Okay, way of cross-checking your answer. So we have discussed, so far we have discussed all these expenses by now. Okay, cost variances done. Next, we are moving on to the sales variances. So let's see what we can do when it comes to sales variances. Sales variances, we categorize. There are two methods of calculating sales variance. That is, we have the turnover or the value method and the margin or the profit method. So let's see. Starting with the value variance, there's only one single word that will make the difference. Okay, so sales value variance, we take the price variance volume. So again, when it comes to sales, it's calculated by how? Price into quantity. So price variance and the quantity variance. Okay. And then next one. Right. All right. So the next one, see, we have the sales volume variance. Okay. So sales volume variance, we have two. Again, we talk about the quantity variance and the mix variance. So don't mess up the sales quantity variance with the sales volume variance. Okay. There are two. Okay. So let's see how we calculate it. Sales value variance, we take the standard sales value minus actual sales value. Sales price variance, we take the change in the price holding quantity constant. If the quantity is constant, we take actual sales quantity. Sales volume variance, there you take the change in the quantity holding price constant. When you're holding price constant, we take the standard price, right? Then we have the sales margin variances. Now see the difference. Sales margin, this is the margin approach. Okay. So sales margin variance, again, only a small change. Sales price variance, now it's the sales margin price variance. Sales margin volume variance, sales margin volume variance. Initially it was sales volume variance. Now it's sales margin volume variance. Okay. So we take these two and the mix and yield or the quantity separate. Okay. So see, this is the sales margin variance simply budgeted. What do you mean by margin now here? So later on, we will be talking about this margin. Margin kya nalamai, the profit. Okay. So budgeted or the standard margin minus actual margin. So how do you get the price margin price variance? So price change in the margin multiplied by quantity. So standard margin minus actual margin multiplied by the actual sales quantity. Sales margin volume variance, change in the volume multiplied by actual sales margin. Standard sales margin. How do you get the sales margin? Now the standard margin, actual margin, how do you get it? Standard margin per unit is standard selling price minus the standard cost per unit. Okay. How do you get the actual margin per unit? See, there's a very important point to note here. Actual margin per unit is equal to actual selling price per unit minus standard cost per unit. Okay, actual selling price per unit minus standard cost per unit. Even though it's the actual selling price, the cost is the standard. Okay, remember that, keep in mind. Okay, then the mix variances. So the only difference is there will be margin coming in. Okay, so if it is the sales mix variance, it is the standard price multiplied by total actual sales quantity on actual production multiplied by standard mix minus total actual sales quantity multiplied by actual mix. Okay. Then standard quantity variance, you take the standard price multiplied by standard total standard. Okay, remember total standard sales quantity on actual production multiplied by standard mix. Okay, and then actual sales quantity into standard mix. And the only difference when it comes to sales margin is that instead of standard price, you take the standard margin. Okay, keep that in mind. So those are the sales variances. So we will be doing a past paper question at the latter part of the session. So we are not doing questions here and there. Okay. Right. Now we are getting on to the documentation. So Lamai, what is this? In addition to cost and sales variances, there is another variance which we call as planning and operational variances. Then Lamai, initially, okay, now imagine this is 2024 now. So before commencing 2024, we had the original standard. Okay, back in 2023 September we prepare a budget. Okay, this is our standard cost. 2024 we prepare a standard, original standard. Once you begin 2024, the situation seems to be different. So you have to revise the standard. So you make a revised standard. Okay, then we have the actuals, which is at the end of 2024 year, you will get the actuals. So Lamai, there can be variances among these two statements, these three statements. So when it comes to the original standard, and the revised standard, the reason, okay, why there is a difference, why my 2023 September budget and 2024 February budget is not same, why it's contradicting, because of some planning inefficiency. I haven't, planned the budget properly. That's why I get a variance. So we say it's a planning variance. And then we have the other one, our revised budget and the actuals. That is not because of my planning inefficiency. That is because of some operational variances. So we call it the operational variances. Right? Now let's see how we calculate. Planning variance. So this doesn't need to be, the cost per se. Okay? Not always the cost. It can be the sales revenue as well. So planning variance, you take the standard cost as per original standard minus the standard cost as per revised standard. Then we have the operational variance, that is where we take the revised and the actual. Okay, so this is the formula. Right. Then we come to the last part of the session. That is where we talk about the operational statement. So Lamai, once then, what's the whole purpose of calculating all these variances? Material ki, sales ki, labor ki, variable overheads, fixed overheads. What's the whole point of calculating all this? It is to make sure that we reconcile our budgeted profit and the actual profit. So so we start with our budgeted profit and we have shown, okay, these are the variances. That's why our actual profit is different from the budgeted profit. So this statement, we call it as the operating statement. This operating statement you can prepare using two methods. We have the absorption costing method and the marginal costing method. There's a small difference in the presentation. See, when it comes to absorption costing we don't take a line item called contribution. So you take the profit directly. So you start with budgeted profit and with actual profit. So what are the adjustments? You put the sales margin volume variance and then take the standard profit for actual sales. And then you take the other variances, sales price, material price, usage. So many rates tika, many variances tika vitarai you could adapt to the operating statement under absorption costing. Okay, only these variances you can put in. Okay, and see fixed overheads tapi dala තියෙනවා. But marginal costing wala hadanne yaddi kohomada? Budgeted, you start with contribution because in marginal costing we have a line item called contribution. So budgeted contribution to actual contribution and from actual contribution to actual profits. Okay. So see, budgeted contribution gatta sales contribution volume variance එක ගන්නේ. Okay. Contribution volume variance and standard contribution on actual sales are same variances, but see fixed overhead tika naha, fixed overheads naha, and then you get the actual contribution and then only you adjust the fixed variances. Okay, budgeted fixed overheads and the fixed overhead expenditure variance. ඔය ටිකම තමයි තියෙන්න ඕන ළමයි. So there's nothing new. You have to study the format. Okay. Right. Then අපි යමු to do a past paper question ළමයි. Okay. See, this is a past paper question 2023 July past paper. So read the question. So ළමයි දැන් බලන්න. Right. All right. So now see this Oval Limited. Okay. Oval Limited manufactures and sells product P. The following information has been extracted from the standard cost card. So may the standard costs. Okay. Material 2 kilograms at 500 per kilogram. And then it passe production. Now see labor, there is a mix. Okay. And then variable overheads and the selling price, everything given. And the company is currently in the process of analyzing the performance of June 2023 and the actual production and sales quantity for the month is 26,000 units, actual production. And the actual figures are also given. You are required to calculate the labor cost variance, labor rate variance, and the labor mix variance and the yield variance. Now see. Labor, we are starting with the direct material cost variance. You take the standard cost on actual production minus actual cost. So what is the standard cost on actual production? Which is 1,000 rupees per unit multiplied by actual production. Remember, not standard into standard, api multiply karanne. Standard unit per unit material usage cost multiplied by the actual production. Daha into 26,000 and your actual material cost, they say it is how much? 26,000, 26 million, this much. Okay, 26 million, 10,400. So then you take the difference, there is an adverse difference. Then direct labor rate variance, how do you take? You take the actual hours multiplied by standard rate and actual rate. So you can see labor, but how do you take the rate? Okay. You have to take individually, okay? For production staff separately, supportive staff separately. Production staff, the rate is 800, but they have actually incurred how much? See, you can divide these two figures, the cost divided by the hours and get the rate. Okay, so it would add up to how much? 825. Then you get the adverse variance. And then supportive staff, same way. your your actual product hours is 41,600 multiplied by 500 minus what is the rate? 24,000. This actual cost divided by actual usage, then you get 580. So both are adverse. You have to add those two together and show the direct labor rate variance. Right? Then we have the direct labor mix variance. So you have the standard rate, actual hours into standard mix minus actual hours into actual mix. Standard, again, you have to take separately. Production standard rate is 800. Okay, see 800. Actual hours how much? It is 12,480. See, 12,480 plus 41,600. So total 54,080. So 54,080 is your actual hours multiplied by, see, total actual hours. Okay, we don't take only for production. Multiplied by 0.5 over 2. How did we get 0.5 over 2? The standard mix. 0.5 hours and 1.5 together, it's 2 hours. So 0.5 over 2 hours, you get the standard mix for production labor. And then we have the other one, actual hours, again 54,080 multiplied by actual hours. Actual mix. How do you get the actual mix? It is 12,480 out of 54,080. Right? Then you get the difference. Same way for supportive staff, you get 500 the standard rate multiplied by the actual production multiplied actual usage. Okay, actual total usage multiplied by the standard mix. 1.5 over 2. Okay, standard mix minus actual usage into actual mix, which is 41,600 out of 54,080. Then you take the variance. Same way variance, and you have to add those two and show. Okay, don't stop here. Direct labor yield variance, then we have, you take the standard rate minus multiplied by standard hours into standard hours on actual production lamai into standard mix minus total actual hours on actual production multiplied by actual mix. So again, separately, production staff 800 multiplied by 52,000 gatte kohomada. Now, they have these two rates, hours. Okay, total 2 hours per unit. 2 hours per unit. How many actual units? 26,000. So what is your total labor usage? 52,000. Right? So 52,000. 52,000 and standard mix and actual production, you know. Same way you get for supportive and production staff and then take the total. Then we have the direct labor yield variance. Direct labor yield variance. So how do you get the direct labor yield variance? You can see. So this one might confuse you. So rather, I would recommend you all to use the formula. How do you get the direct labor yield variance? What is the formula? See the PPT. So this PowerPoint will be shared with you all. Okay. So direct labor yield variance, you take the standard rate multiplied by total standard hours multiplied by standard mix. Total standard labor hours multiplied by standard mix. So how do you get the total standard labor hours on actual production? Okay. And total labor hours into standard mix. So how do you get? This is 52,000. Okay. You know already how we got 52,000. That is 2 into actual production, 26,000 units. See, we got 52,000. So you can apply the formula and see whether you get the same. So for this type of a question, you get 10 marks. Okay. So here yield variance. Okay. And then we go on to the next question. So Lamai, this is the other question. Please read through. So this is 2023 January. Okay. So this question, it has the operating statement. So hence you're getting 15 marks. Okay. So very important. So read through this question now. All right. So now let's see this question. Explorer Limited manufactures and sells product W for which the following information has been extracted from the standard cost card. Same way, see Lamai, this is the same exact question, okay? So that's why we say you should practice, okay? If you practice Lamai, these questions, you can see the pattern. It's the same question that they have repeated again, only the figures they have changed, okay? So if you're lucky enough for this time exam also, you might get a similar question, okay? So once you practice the past papers, you will get the trend, okay? So see here, the material they have given, only few names they have changed, okay? So they have given the actual and all those things, sales price and the other variances, and they have asked you to calculate the labor rate mix yield and the price sales price variance and the other operating statement to reconcile using contribution, okay? Actual contribution. So they are asking for the marginal approach, okay? See, this is the answer. Okay, so you get the first one, direct labor rate variance. Okay, so you have to take the standard rate minus actual rate. and you multiply by the actual hours paid for. Okay, remember. Skilled labor, you take, the actual and the standard rate. Actual and the standard rate. So you get the actual rate is 300, sorry, standard rate is 300, actual rate is, here you have to get it by dividing the cost by the total actual hours. Okay, 320 and multiply by actual hours, 624,000. And then unskilled also same way, you get the balance. Then we have the direct labor mix variance. So there, how do we take? We take the actual mix. Okay, so what is the formula? So you might mess up here. Okay, so you all know how to calculate. So this answer you might not get at the direct glance. You might not get it. So what I recommend is to use the formula in the PPT. See, mix variance, you take the standard rate. What is the standard rate in this question? See, what is the standard rate? 300 for skilled, and then total actual labor hours. What is the total actual labor hours? It is simply addition of these two, 624,000 plus 1,685, 168,000. Okay, total of those two multiplied by the standard mix. What is the standard mix? Now it is 2.5 total, 2 over 2.5. That is your standard mix for skilled labor. Then what is the standard mix for unskilled labor? It's 0.5 over 2.5. Right? And then the other one is actual labor hours, same thing, multiplied by actual mix. What is the actual mix? It is 624,000 over the total of these two. Okay. Then, how do you get the direct labor yield variance? Standard rate, which is 300, multiplied by standard labor hours on actual production. What is standard labor hours? That is 2 hours into what is the actual production. They say actual production units, 320,000. Okay. That is for 320,000 for, skilled, but you have to take the total. So you have to do the same for unskilled. So easily what we can do is we can take 2.5 multiplied by 320,000. So you get the total actual standard labor hours on actual production, 800,000. Okay. Then you multiply it by the standard mix. What is the standard mix? It is 2 over 2.5. And again, actual labor hours, it is addition of these two multiplied by 2 over 2.5. That is for skilled labor. For unskilled labor also, same way, the standard mix would be 0.5 over 0.5 over 2.5. Right? Great. Then what do they ask next? Then they have done the sales price variance, which is very easy. You take the actual sales, 320,000 multiplied by the actual sales price. How do you get the actual sales price? They have given the sales revenue. They have given the actual sales quantity. Divide the revenue by the actual sales quantity, which they have done here, and get the value. And then actual selling price they have given, it's 1,550 here. Budgeted. Then you get the difference. Then you are supposed to prepare the contribution and operating statement under marginal approach. So when you prepare the operating statement under marginal approach, you all can see we start with the budgeted contribution. So what is the contribution? Budgeted contribution, it is 235 multiplied by budgeted production 300 units. Then sales contribution volume variance, which is given in the question directly, sales contribution, sales margin or contribution we say, okay, same thing, okay. Then budgeted contribution of actual sales they have given, and then the variances. You have to adjust the variances. Remember the format, okay? Given in this slide, okay? Remember the same format. So you take the sales price variance, direct material price, usage, labor rate, labor efficiency, idle time, overhead, and all that. So imagine, Lamai, if they have given you the direct labor, if they have given you the direct labor mix and yield, and also they have given the direct labor efficiency variance, which do you select? Remember, Lamai, the yield and the mix variance together adds up to direct labor efficiency variance. So you don't have to add the direct labor efficiency. If you are adding direct labor mix and yield into the statement, then you don't need to add the efficiency. Okay, you're double counting. Remember. Okay, but if you are adding efficiency, then you don't need to add the mix and the yield variance. Okay, remember it applies to direct material as well. Okay, අර sub ඒවා තියෙනවා නම් ඒ sub එක දානවා නම් you don't have to put the main item separately. Okay, you don't have to. And see, contribution ගන්න නිසා you take the variable overheads first, and then actual contribution අරන් you adjust the budgeted fixed overhead. So here in this question, they haven't put the fixed overhead computation. But why they haven't put it? Because in the question, they are asking, prepare a operating statement where you get from actual budgeted contribution to actual contribution. Statement එකේ භාගය ඉල්ලන්නේ. So you don't have to put the fixed variance overheads itself. Okay. So you have to put the variances accordingly. ඊළඟට ළමයි බලන්න. See, this adverse and favorable, you have to adjust them accordingly. හරිද? Adverse variances මොනවාද? Favorable variances මොනවාද? Accordingly, you have to add it. Okay? See, that is how you get it. Okay? Actual contribution. So finally, so for all this, you get how many marks? You get 15 marks. Okay? So read the question carefully, Lamai. Okay? You have to get the 15 marks. This is easy 15 marks, Lamai. You can easily get this mark. So do not mess up this question this time, because now you all know now how to get the exact variance. Okay? How to get this 15 marks, you all know. Okay? So with that, we come to the end of this session. So if you all have any questions, Lamai, since this is a recorded video, this will be uploaded to all social media platforms of AAT Institute. So if you all have any questions, you can, drop it, comment it on the chat box in the YouTube channel. You can go and comment your questions. So then we would be able to answer whatever doubts you all have. Okay. And if you all need any queries, you can always, reach out to AAT Institute, and they will reach out to us. Right? So with this, we would like to conclude today's session. So Lamai, we would conclude from this point. So if you all have any queries, please do the necessary. And yes, I wish you all a very good luck with your exams. And do it well and study the formulas well. So one suggestion I would like to give is, what you all could do is take 2 separate A4 sheets. Okay, and then write each and every formula in it. Okay, write each and every formula, and then you study that. Okay, do a lot of past paper questions, and with that you are ready for the exam. Okay, Lamai. So with that, we would conclude today's session. Thank you, everyone.